Good morning. It's Friday, the 24th of October, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital, and we have rains again. The top stories and themes. The stock markets rise for a sixth day now as optimism takes over. US sanctions on Russian oil majors will affect India. India's vast talent pool is a magnet for more GCC business verticals, and the latest is energy. Tesla posts losses again, though its CEO wants a $1 trillion salary.
This is the Core Report with Govindraj Ethiraj.
A good Diwali week. Well, it's been a good Diwali week, at least so far, with India's equity benchmarks rising for the sixth consecutive trading session. There is renewed optimism on resolution on the India-US trade talks, with several hints and suggestions of some form of compromise on the 50% tariffs imposed on India by the United States. Now, it must be noted that India is facing a 25% tariff only for importing Russian oil, which could come down, and more on that shortly. The other 25% duty may well continue and is still amongst the highest in the world, and is also pretty much the figure first unveiled as part of sweeping tariffs across the world in April by US President Donald Trump, which means that there has been no negotiation impact before or since then. So if we are to see a lower tariff, then even 25%, as some are speculating, that would mean that there has been a fairly successful round of negotiations or is going on. But that is something we are yet to see anything firm on, and nothing is firm till President Trump announces it. And of course, it can change even after that, as we've seen with China. Meanwhile, Indian stocks are powering ahead. Trading on Thursday started on a very strong note, though it moderated from highs thanks in large part to IT stocks, which drove the rally. The Sensex hit a fresh 52-week high of 85,290 and was up 864 points at the highest point in the day, and then closed down 130 points up to 84,556. The NSE Nifty 50 was up 23 points to 25,891. The last 6 trading days has seen the Sensex rising about 1,526 points and the Nifty about 745 points. On Thursday, Infosys was the big gainer in the BSE 30 stock Sensex, which was up 4% after the company's promoters opted out from a 18,000 crore rupee share buyback. Other IT stocks were also up once again on US-India trade optimism. In the broader market, the BSE Mid-Cap Index was down 0.2%, the Small-Cap Index was down 0.5%. Oil drama. Now, there is a fair bit of renewed drama in the oil markets, with the US now imposing sanctions on 2 top Russian oil producers, which of course affects everyone importing from them. A Reuters report says Indian refiners are poised to sharply curtail imports of Russian oil to comply with these new US sanctions on these producers. Multiple trade sources also told Reuters that Chinese state oil majors have suspended purchases of seaborne Russian oil from these 2 companies. India has been the biggest buyer of discounted seaborne Russian crude after the 2022 invasion of Ukraine by Russia, and India imports about 1.7 million barrels per day, or at least it did in the first 9 months of this year. Now, the US has sanctioned Lukoil and Rosneft, which are Russia's 2 biggest oil producers. This means that refineries in China and India will need to seek alternative suppliers to avoid exclusion from the Western banking system, according to analysts who spoke to Reuters. The US also said it was prepared to take further action as it called on Moscow to agree to a ceasefire in Ukraine. There is, of course, continued skepticism in the market about whether these sanctions would result in a fundamental shift in supply and demand. Another analyst told Reuters that so far almost all the sanctions against Russia in the past 3.5 years have mostly failed to dent either the volumes produced by the country or the oil revenues. Now, back home, Reuters reports that Reliance Industries, which is India's biggest buyer of Russian crude, is planning to reduce or cease imports of Russian oil, including halting purchases under its large long-term deal with Rosneft. A Reliance spokesperson told Reuters that recalibration of Russian oil imports is ongoing and Reliance will be fully aligned to Government of India guidelines. On a question on whether it planned to cut its crude imports from Russia. Now, it's not clear what the GOI guidelines are here because the sanctions are on Russian exporters and GOI guidelines on the matter, if so, are yet to be revealed, and once again, at least to us. Meanwhile, Bloomberg reported that the latest restrictions announced by the US blacklisting Russia's largest producers would make it all but impossible for flows to continue. So far this year, India has taken over 36% of its imports from Russia, Bloomberg said, quoting analytics firm Kepler. And historically, however, as we've been discussing here, India has actually not been a significant importer of Russian crude and has depended more heavily on the Middle East. Now, after 2022 and that invasion of Ukraine and a $60 per barrel price cap imposed by the G7 nations, which aimed to limit Kremlin's oil revenues, that of course prodded India to start importing Russian crude. Bloomberg also says that in the short term, the latest sanctions will mean that orders due to be placed in the coming week for crude that will load in November and deliver in December will now be overwhelmingly from other destinations. Vandana Harif, founder of Singapore-based Vanda Insights and a frequent guest on the core report as well, told Bloomberg that with this sanctions move, Indian refiners may have to pull back way faster, though she says that it'll be probably relatively easier for India, which was not buying any Russian crude until 3 years ago, compared to China. And then oil prices rose nearly 5% on Thursday after the US imposed those sanctions. Brent crude futures were up about close to $3 to about $65.50 a barrel, while US West Texas intermediate crude futures were up about $2.9 to $61.43 a barrel. Another breed of GCCs. There are always newer business verticals where multinationals are setting up captive centers in India. One interesting one was McDonald's a few months ago, with large captive centers coming up in Hyderabad. Now, there are a few factors that have driven the growth and mushrooming of global capability centers, as they're called in India. The first is most likely trust and confidence that the Indian arm, which will be tethered to a global process or value chain, will deliver consistently and in a manner that data and other IP can be moved back and forth securely. The second, of course, is capability and talent. In all respects, more companies ranging from pharmaceuticals and engineering research and development to other forms of back office management are setting up shop in India in recent years. One such area which could see increased opportunity is energy, according to a new report from consulting firm KPMG. And perhaps an interesting time to discuss this, given today's episode's focus on energy issues, particularly oil. While energy majors like Chevron are already in India with GCCs, the potential is large, according to a new report from KPMG titled From Cost Center to Nerve Center of the Energy Enterprise Global Capability Centers. I reached out to KPMG partner Shalini Pillay and an author of this report, and I began by asking her what was different about the opportunity for energy GCCs.
Like you rightly said, today the GCC model is spread across every industry sector you can think of. And part of what makes the model actually feasible is the fact that it's leveraging the digitalization that's happening across global organizations. And this model saw a fillip through COVID, which really means that it enabled anything that could be done leveraging technology that could be processed remotely could actually be enabled by the GCC model. So in some sense, to your question, it's not really dependent on where the organization is physically sitting, but one is taking advantage of what technology is doing, how you're digitalizing the entire business value chain, and that is what is coming together really effectively. So to give you an example, while you rightly pointed out, a lot of energy majors have local assets and they tend to be very localized. But there are two dimensions to this. One is the GCCs are actually working to create digital twins of these global organizations. So if you imagine that and you imagine a digital twin sitting remotely here in India, you have suddenly an opportunity to monitor your assets, to influence those assets, to track how they're doing, to optimize it remotely. So it's a combination of the typical technologies, industrialization. If you look at IoT and the operating technologies that are coming together, all of that creating a beautiful digital web, which allows you as the GCC to then be in that cockpit, steering, monitoring, influencing global operations. And that's why it becomes very relevant and as relevant to a global energy major on their hardcore operations on the downstream side of it. If you look at energy customers who are changing, there's also significant impact from a customer experience perspective, who are now increasingly demanding, just like you would see it in some of the consumer industries.
So if you were to illustrate that, so let's say you talked about operations and driving operations, apart from the digital twin aspect, where you're really recreating the whole, let's say, architecture or system in another place, but digitally. What would be a good way to understand what's going on, the complexity of what could be done or is being done?
Like I said, if you imagine the digital twin of a plant or an oil rig, and where you're actually monitoring the assets sitting over there, your ability to actually track the life cycle, track the asset life cycle, the maintenance requirements is one example. For oil and gas majors that have vast gas pipelines, for example, today they use drones to actually track these pipelines. A lot of those drones, the architecture that drives the software there is being run, designed, monitored from India. Of course, equally scary is the cyber element, which is why the security architecture is really important. So GCCs are not only becoming this digital nerve center, they are creating a super resilient layer around it where the cyber technologies, everything that's required to make sure you have the strong digital trust environment built around it is also happening here. So you're monitoring your assets, monitoring these gas pipelines, you're looking at the life cycle. Where is it that you need to actually do your repairs, maintenance, asset management? All of that's possible from here. And they build robust security architectures that actually ensure this is super secure.
Right. When you wrote this report, so one is, of course, I guess you're looking at people who are already in India doing all of the stuff that you talked about. But I'm guessing you're also suggesting that there is opportunity for others to come and do this as well.
Yes.
Is it doing more stuff here, or is it others or new people to come here and do the same stuff plus?
Actually, it's both. And this again applies across every industry. There's an opportunity for the uninitiated to kind of understand the model and take advantage of it.
Is that more in energy, you feel?
No, the energy, it's a little less. You have a handful of large players. There are a bunch of mid-sized. But compared to some of the other sectors, I would say you don't see as many in the energy space. But there certainly are players who are not here yet who will look to come in and set up shop for sure. But the opportunity is equally large, Govind, for the existing players. So traditionally, they did a lot of the corporate function support, which was now being done and dusted with, all of the IT, finance, HR, some of supply chain. But now the opportunity to go up that value chain because you are embedding technology increasingly in core processes. So the more your core gets tech enabled, the higher the opportunity for the GCC to actually support. So there are new avenues opening up as you kind of move up that value curve, so to speak. If you look at retail outlets for a lot of the energy players at their gas stations, some of that is now getting more and more digitalized. Imagine when you then track that consumer experience and connect all the dots to actually open new revenue channels. A lot of that can be done through data analytics, data mining that's now getting done out of the GCCs.
Interesting. So you're saying, for example, if it were a BP or a Shell gas station in Great Britain or somewhere in Europe, then the data that's flowing from those stores in the gas stations could be or is being monitored and worked upon in India.
Could be analyzed from here. Then you look at mining that data to see what more you can then do. And
right. That's not an energy operation. I mean, it's an off energy.
That's an off energy. But that's an example to say that there are newer dimensions to energy. The energy consumer is getting more conscious, and that opens up another set of opportunities. But to your earlier question, the more you see technology embedded in core operations, the more opportunities for the GCC to play a big role.
Right. And how are you seeing the talent stroke skill flow for serving all of this in India?
It's the talent that's attracting players here, right? The challenge, of course, is for us to ensure we sustain that talent and keep a very healthy, growing pipeline if you want to keep increasing the number of GCCs coming in. But that, like you're aware, is today very much a national agenda. It's a state agenda. And there's some good work happening there, Govind, in terms of upskilling talent. And I think increasingly wave 2 is going to be techno-functional talent. So which means you take your engineers who work in the energy space and look at upskilling them with the right tech skills. It's not just taking the IT software engineers. So what's going to be more and more relevant as you penetrate the value chain is to actually look at players who understand the domain in depth and then can apply operational technology, look at Gen AI and some of those newer technologies, combine it in a very meaningful way. So the future is going to be more techno-functional.
And that's an interesting term. So if I were to ask you to put a number on it, so let's say an energy GCC hires 100 people, how many of them would be energy stroke petroleum engineers, percentage-wise, roughly?
My guess is not very high at this point. I think it would probably be more like, and I'm just throwing a wild guess here, probably be like 25-30%, because a large part of that skill today is pure tech, the software engineers, because of the nature of work that was done so far. But as that moves up, I think the opportunity to pivot to more core domain skills coupled with tech skills is only going to grow.
Right. Shalini, it was a pleasure speaking with you. Thank you so much for joining me.
Thank you so much.
Musk wants a $1 trillion pay package from Tesla. Now, the news is that Tesla has reported record third quarter revenue, which has also been driven by high quarterly sales thanks to expiring electric vehicle tax credits in the United States. But profit also dropped 37%, partly due to costs. And it's quite clear that Tesla is not immune to the cost pressures affecting the auto industry, as a report in Reuters points out. Analysts also said that the margin compression is the real concern, and higher operating expenses, increased tariffs, and lower regulatory credit revenue have hit all at once. Musk, of course, wants to position Tesla as a company focused on robotics and self-driving technology, and that has helped or maybe kept investor optimism going. The stock has been trading at more than 200 times the company's profit expectations, which, by the way, is way higher than any other tech company or mega cap stocks, as they're called. So just on that price to earnings, Tesla's forward price to earning is 200. Now, can you guess what Apple is, the company whose phones you perhaps own or would like to, as many would say? Apple is at 33. I repeat, Tesla is at 200, Apple is at 33, Microsoft is 32. Nvidia, whose stock has been setting the bosses on fire, is at 30. Amazon is also at 30. Alphabet is 24. And then if you just want to contrast with old economy companies, Ford Motor is 9 and General Motors is 7. We're talking about forward price to earnings ratio. And it's Friday and feedback time. So let's pick up some of the feedback that you've been sending us. So firstly, thank you very much for it. Slam Can says, superb guest on your goal story, lucid and sound. So thank you, Amit Goel, for sharing your thoughts. Amit Goel is from Pace 360 and did offer a fairly strong counter view on where he felt gold prices should be going or should not be. In effect, he was arguing that it was a bubble. Virag Padalkar says, isn't the bubble more in equities than gold? That's true. If you were to look at US stock prices, which are continuing to hit all-time highs, and of course there are many other markets in the world, it is quite likely that there is a bubble-like phenomenon there right now. But bubbles, I guess, are only best assessed in retrospect or in hindsight when something explodes or the bubble quite literally bursts. So let's see. Shri Balaji Sampath says, wishing you a very happy Diwali, Mr. Govind. I listen to your core report every day and look forward to it. Appreciate so much effort you put into it every day. Thank you. Yes, Balaji, thank you so much for your Diwali greetings. And I wish you and everyone listening actually a very happy Diwali once again as we come to the last day of Diwali. And finally, Sweet Poison says, excellent report on AI evolution, very informative and insightful. Thanks for the efforts, loving these morning briefings. I'm guessing you're referring to our take, which is our editorial of sorts on whether India should go the America way, for example, in setting up data centers. The argument, at least that we're making, is that data centers are good, we need them, but how much and how big and how soon is really the question, because a lot of data center capacity or the additional data center capacity or incremental data center capacity is being driven by AI and needs of AI, which of course is something that still has to bear out in its true form. So we do need data center capacity, but whether we need to double and triple in a few years is really the question, because it is a drain on resources, not just energy, which is a question mark for relatively energy scarce countries like India, but also on resources like water, which you need to cool those data centers. So this is a question that people all over the world are asking. So it's not just in India, it's just that we are catching it at an early stage. In the US too, this is a very important question that's being posed, particularly by communities around these data centers, where there is a strong feeling, and based on some data, that among other things, data centers have also driven up energy costs for those communities. So on that note, thank you very much once again for all your feedback. Love listening to them. It gives us hope and encouragement, and see you soon. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.